Hey everyone, welcome back to the channel. Today, we'd re-diving deep into a topic that many of you are working towards, a significant financial milestone. It's not about hitting $1 million, but a number that, for many, represents a massive psychological turning point. We're talking about reaching $250,000 in your invested net worth. Why this specific number? Because something truly magical happens in your brain when you cross this threshold. It's a shift from scarcity to abundance, from defense to offense, and it fundamentally changes how you view money, risk, and life itself. So, if you're on this journey or just curious about what lies ahead, stick around. We're going to break down the 5 key mental shifts that occur and how they can accelerate your path to true financial freedom. Let's start with the first and arguably most important shift. You finally start to feel the power of compounding. When you're just starting out with a few $1,000s invested, the growth can feel painfully slow. You might put in $100 and it grows by $8 over a year. It's hard to get excited about that. You might even wonder if all this effort is worth it. But when you have $250,000 invested, the numbers start to become very real. An average 8% return on that amount is $20,000 a year. That's over $1,600 a month. This isn't just pocket change anymore. This is a significant amount of money being generated while you sleep. You start to realize that your money is now a powerful employee, working for you 24/7 without ever needing a vacation or a coffee break. This visible, tangible growth makes the concept of compounding click in a profound way. It's no longer just a theory in a book. It's your reality. This validation fuels your motivation like nothing else, making you want to save and invest even more aggressively. The second major shift is that your risk tolerance begins to change. Early on, every market dip feels like a personal attack. When your portfolio is small, a 10% drop can feel devastating because it represents a significant chunk of your hard-earned savings. You might panic sell or question your entire strategy. But with a $250,000 portfolio, you've likely weathered a few storms. You've seen the market go down and you've seen it come back up. You have a larger cushion. A 10% drop is still a $25,000 paper loss, which is never fun, but it doesn't threaten your survival. You know you have a solid base, and you've developed the resilience to see market fluctuations as opportunities rather than threats. You start thinking, hey, the market is on sale, maybe I should buy more, instead of, oh no, I need to get out now. This shift from a defensive mindset to an offensive one is crucial. You begin to play the long game with more confidence, understanding that volatility is just the price of admission for long-term returns. This leads us directly to the third psychological shift. The FU money mentality starts to kick in. Now let's be clear, $250,000 isn't enough to retire on forever for most people. But it is enough to give you a powerful sense of security and options. It is the amount of money that allows you to walk away from a toxic job without having another one lined up immediately. It's the freedom to take a 6-month sabbatical to travel or pursue a passion project. It has the confidence to say no to opportunities that don't align with your values. This is what FU money is all about. It's not about being aggressive or rude to people. It's about having the power to control your own life and your own time. Before reaching this milestone, your decisions are often dictated by your next paycheck. After you start making decisions based on your long-term happiness and well-being. This sense of agency is incredibly empowering and can dramatically improve your quality of life, even if you don't actually quit your job. Just knowing you could changes everything. The fourth shift is a change in your perspective on income and spending. When you're building from zero, your primary focus is on saving every penny. You're cutting coupons, brewing coffee at home, and saying no to nights out. Your main wealth-building tool is your savings rate. However, once you have a $250,000 portfolio working for you, you realize something interesting. While saving is still important, the returns from your investments start to become a major contributor to your net worth growth. Remember that $20,000 a year from an 8% return? For many people, that's equivalent to getting a massive raise at work, but it happened passively. This makes you think differently. You might realize that spending an extra couple of $100s a month on things that genuinely improve your life, like a gym membership or a cleaning service, won't derail your long-term goals. Your investment engine is strong enough to handle it. You move from a mindset of pure deprivation to one of optimization. You start asking, how can I use my money to buy back my time and increase my happiness without feeling guilty? Finally, the fifth and most profound shift is that you start to think bigger. Your financial goals evolve. When you first started, your goal might have been to save a $10,000 emergency fund. So there you have it. The 5 incredible psychological shifts that happen when you hit $250,000 in invested assets. You feel the power of compounding. Your risk tolerance evolves. You gain the confidence of few money. Your perspective on spending changes, and you begin to think much, much bigger. This milestone is so much more than a number. It's a gateway to a new level of financial and personal freedom. If you're on this path, keep going. Every dollar you invest is building not just wealth, but a more resilient, confident, and empowered version of yourself. The journey is absolutely worth it. Thanks so much for watching today. If this resonated with you, or if you've experienced these shifts yourself, I'd love to hear about it in the comments below. What was the financial milestone that changed your mindset? Let's get a conversation going. And of course, if you found this video helpful, please hit that like button and subscribe for more content on building wealth and living a richer life. See you in the next one. Hey everyone, welcome back to the channel. Today, we're going to talk about something a bit counterintuitive, a hidden trap that many people fall into on their journey to financial freedom. We often celebrate milestones, right? Hitting your first $10,000, then $50,000, then the big $100,000 in investments. But there's a particular number that seems to create a dangerous psychological effect, and that number is $250,000. Reaching $250,000 is a monumental achievement, no doubt about it. It's a point where you can finally breathe a little, where the dream of financial independence starts to feel tangible, not just some far-off fantasy. But this is also where the real danger begins, the danger of complacency. Think about it. The journey to your first $250,000 is often a grind. It's years of disciplined saving, sacrificing nights out, driving an older car, and maybe even working a side hustle. You're fueled by this intense desire to escape the rat race. Every dollar you save and invest feels like a victory. You're constantly learning, optimizing your budget, and pushing forward. But once you hit that $250,000 mark, something shifts, the pressure eases. You look at your portfolio and see a number that's bigger than what most people have saved in their entire lives. You start to think, I've made it. I can relax now. And that, my friends, is the complacency trap. The problem is that while $250,000 is a fantastic start, it's not the finish line. It's more like reaching a base camp before you attempt to summit Mount Everest. The air is thinner up here, and the next part of the journey requires a different kind of discipline. If you let your foot off the gas now, you risk stalling out completely. I've seen it happen. People who were once super savers start to loosen the purse strings. That daily $5 latte doesn't seem like a big deal anymore. A new car? Well, I've been so good I deserve it. A bigger house? The portfolio can handle it. These small lifestyle upgrades, what we call lifestyle inflation, start to creep in. And they are silent wealth killers. Let's break down the math because numbers don't lie. Let's say you're 30 years old and you've just hit $250,000. If you completely stop contributing and just let that money grow at an average of 8% per year, it would take about 18 years for it to reach $1 million. You'd be 48. Not bad, but what if you had kept up your momentum? If you continued to invest just $500 a month, you'd hit that $1 million mark in about 14 years, at age 44. If you pushed it to $1,000 a month, you get there in just over 11 years, at age 41. Those extra years of financial freedom are what you sacrifice when you become complacent. You're essentially trading your most valuable asset, time, for a little more comfort in the present. The psychological pull of complacency is strong. Our brains are wired to seek comfort and avoid discomfort. The relentless saving and investing required in the early stages is uncomfortable. So when we reach a goal that feels significant, our natural instinct is to reward ourselves by easing up. We tell ourselves we've earned a break, and you have. But the break shouldn't mean abandoning the habits that got you here. It should mean celebrating the milestone, maybe with a nice dinner or a short vacation, and then getting right back to the plan. The real reward isn't the new gadget or the fancy car. The real reward is the future freedom that your investments will buy you. Another danger of complacency at this stage is what I call autopilot arrogance. You've had some success. You pick some good stocks or funds, you've seen your net worth grow, and you start to think you've got it all figured out. You might stop learning, stop re-evaluating your strategy, and stop paying attention to changes in the market or in your own life goals. The financial world is dynamic. What worked for the last 5 years might not work for the next 5. Getting lazy with your financial education is just as dangerous as getting lazy with your savings rate. You have to stay engaged. Keep reading, keep listening to different perspectives, and never assume you know everything. The moment you think you re an expert who can't be wrong is the moment you become vulnerable to a major mistake. So how do we fight this? How do you push past the $250,000 wall and keep your momentum going toward that first million and beyond? The first step is to redefine your goal. Your goal was never just to hit 250,000. That was a milestone, a checkpoint. Your real goal is financial independence, the point where your investments generate enough income to cover your living expenses, and work becomes a choice, not a necessity. This goal is likely a much bigger number, probably 1 million, 2 million, or even more, depending on your desired lifestyle. You need to have that bigger number clearly defined and written down. Keep it front and center. When you feel the urge to splurge, look at that ultimate goal and ask yourself if this purchase is really worth delaying your freedom. The second strategy is to automate and escalate. You've already built the habit of saving and investing. Don't let it become a manual process again. Keep your automatic transfers from your paycheck to your investment accounts in place. Even better, try to automate an increase. Set a calendar reminder every 6 months or every year to increase your contribution amount by 1 or 2%. If you get a raise, automatically allocate at least half of that new income directly to your investments, before you even get used to seeing it in your bank account. This way, you're fighting lifestyle inflation before it even has a chance to start. You're building your wealth-building machine to be stronger and more efficient over time, not letting it rust. The third and perhaps most important tactic is to find your why beyond the money. What will you do when you are financially free? Will you travel the world? Start your own business without the pressure of needing it to succeed immediately? Spend more time with your family? Volunteer for a cause you're passionate about? Having a powerful, emotionally charged vision for your future is the ultimate fuel to overcome complacency. Money is just a tool. It's a means to an end. If you don't have a clear and exciting picture of that end, it's easy to get distracted by shiny objects along the way. Your why is what will keep you focused when the daily grind feels monotonous. It's what will make you choose the long-term prize over the short-term pleasure. Let's be clear, celebrating your achievements is important. Hitting $250,000 is a huge deal, and you should be incredibly proud. Acknowledge your hard work. But don't let the celebration turn into a permanent vacation from the habits that created your success. See it for what it is, proof that your system works. It's the sign that you should double down, not back off. The journey from 250,000 to a million can actually be faster and easier than the journey from 0 to 250,000, thanks to the power of compounding. But that only works if you keep feeding the machine. Don't stop now. You're closer than ever to true freedom. Keep your eyes on the real prize, stay disciplined, and keep pushing forward. The future you will be eternally grateful. Thanks for watching today. I hope this gave you a new perspective on reaching those big financial milestones. If you found this helpful, please hit that like button and consider subscribing for more content to help you on your wealth building journey. Let me know in the comments what your next big financial goal is. See you in the next video. Once someone reaches around $250,000 invested, the path ahead becomes clearer but also more revealing. This is the stage where the difference between people who eventually build real wealth and those who stay stuck becomes obvious. Not on the surface, but in the quiet decisions nobody sees. At this point, income is no longer the main factor holding people back. Many people at this level already earn decent money. Some earn very good money. Yet years later, their net worth hasn't moved much. And others with similar income suddenly start accelerating fast. The reason is not luck. It's how they behave when things feel comfortable. Comfort is the most underestimated enemy of wealth. When you're struggling, urgency forces action. When you're comfortable, excuses sound reasonable. You delay investing. You increase lifestyle spending just a little. You tell yourself you'll optimize later. None of these decisions feel dangerous in the moment, but over time they quietly flatten your trajectory. People who break through this stage understand one thing deeply. Comfort must never replace structure. They keep systems in place even when they don't feel necessary. Automated investing, rebalancing rules, clear allocation strategies. Not because they're afraid of messing up, but because they respect how easy it is to drift. This is also where emotional discipline matters more than financial knowledge. You already know the basics. You understand diversification, compounding, long-term thinking. What matters now is consistency when motivation fades. Another major shift at this level is how people react to opportunity. Early on, every opportunity feels rare. After $250,000 invested, opportunities become frequent. That's when selectivity becomes crucial. Wealthy investors don't ask, "Can I make money here?" They ask, "Is this worth my attention?" Attention is limited. Capital is limited. The best investors protect both aggressively. This is why many people at this stage start saying no more often. They decline deals. They ignore hype. They let things pass. From the outside, it looks like they're missing out. In reality, they're protecting focus. Focus compounds faster than effort. Another thing that changes here is how people handle losses. Losses no longer trigger panic, but they still trigger reflection. Instead of reacting emotionally, experienced investors analyze patterns. Was this a bad decision or a bad outcome? Those are not the same thing. This distinction is powerful because it prevents overcorrection. Many people destroy their progress by changing strategies after every setback. Those who accelerate stay anchored to principles, not emotions. At this level, principles matter more than tactics. This is also where patience stops being passive and becomes active. You're not just waiting, you're positioning. You're preparing. You're building reserves so that when the right moment comes, you can move decisively. And moments do come. Market crashes, sector rotations, economic shifts. People with capital and calm minds benefit the most during these periods. This is one of the most unfair advantages of having money invested. It gives you the ability to act when others freeze. Another psychological shift happens here. Your relationship with money becomes quieter. You stop checking balances daily. You stop obsessing over short-term fluctuations. That mental space gets redirected into higher quality thinking. You start thinking about second-order effects, long-term consequences, trade-offs. This is where many people begin thinking about legacy, even if they don't call it that yet. Not just, how much can I make? But what am I building toward? And that question changes everything. People who accelerate past $250,000 invested usually adopt a builder mindset. They think in systems, not events. They don't rely on one source of growth, they stack advantages. This might mean combining career growth with investing, or adding ownership alongside income, or gradually shifting from purely financial assets into strategic ones, but they don't rush it. Rushing is expensive. Another important realization at this stage is that more complexity does not automatically mean more returns. In fact, complexity often hides risk. Simple strategies executed consistently outperform complex strategies executed emotionally. This is why many wealthy investors can explain their approach in a few sentences. They understand it deeply enough to keep it simple. This stage also forces people to confront their true risk tolerance. Not the theoretical one, but the real one. How do you react when six figures fluctuate? How do you sleep during drawdowns? Your answers shape your future returns more than spreadsheets ever will. People who know themselves adjust accordingly. They don't chase what they can't handle emotionally. They choose sustainability over bragging rights. Another thing that changes after $250,000 invested is how you view advice. You become more skeptical, but not cynical. You evaluate sources carefully. You understand that advice without context can be dangerous. This is why many people stop asking, "What should I invest in?" and start asking, "What makes sense for my situation?" That shift alone protects millions over a lifetime. This is also where people realize that wealth is not linear. Progress comes in waves. Long periods of slow growth followed by sudden jumps. Those jumps don't come from luck. They come from being positioned correctly when the environment changes. And positioning requires patience. At this level, people who stagnate usually do so quietly. They're not failing. They're not losing money, they're just not progressing meaningfully. And that's the most dangerous outcome of all, because it feels safe. Safety without growth slowly erodes purchasing power, motivation, and opportunity. People who break through stay slightly uncomfortable by design. They keep investing aggressively relative to their lifestyle. They resist inflating expenses just because they can. They maintain a gap between income and spending. That gap is where acceleration lives. Another subtle change is how success feels. Early wins feel exciting. Later wins feel validating. You don't celebrate loudly. You nod quietly and keep going. This is also where gratitude starts showing up. Not as a performance, but as awareness. Awareness that discipline paid off. Awareness that many people never reach this stage. Awareness that responsibility increases with progress. And responsibility changes behavior. If you're watching this and thinking, this sounds like where I want to be, understand this. The people who reach $250,000 invested are not special. The people who go far beyond it are intentional. Intentional with time. Intentional with money. Intentional with mindset. Drop a comment with the word intentional if this part hit home for you. It helps the video and it shows me you're thinking beyond the basics. After reaching around $250,000 invested, something interesting starts happening beneath the surface. The numbers continue to grow, but the real acceleration no longer comes purely from markets. It comes from alignment. Alignment between how you earn, how you invest, how you spend, and how you think. This is the stage where money begins to magnify your habits instead of fixing your problems. If your habits are strong, growth feels smoother. If your habits are weak, cracks start showing fast. This is why two people with the same portfolio size can end up in completely different places 10 years later. At this level, lifestyle decisions quietly become one of the biggest financial variables. Not because of luxury purchases alone, but because of recurring commitments. Fixed costs, obligations, expectations. People who accelerate past this stage protect their flexibility aggressively. They avoid locking themselves into lifestyles that require constant high income. They understand that freedom comes from keeping expenses lower than potential, not current, income. This doesn't mean living cheaply. It means living intentionally. They upgrade selectively. They spend where it adds value and cut ruthlessly where it doesn't. Every dollar has a job, even discretionary ones. This is also where people begin to realize that time is now more valuable than money. Early on, you trade time for income. Here, you start trading money to reclaim time. Outsourcing tasks. Buying convenience, reducing friction. That reclaimed time often gets reinvested into higher leverage activities. Better work, better thinking, better health, and that creates a feedback loop. Another major shift at this stage is how people think about growth sources. Instead of relying on a single engine, they start building multiple ones: career growth, investment growth, optional side ownership, not all at once, not recklessly, but deliberately. They don't chase side hustles out of desperation. They explore leverage out of curiosity and strategy. This is an important distinction. Desperation creates noise. Strategy creates clarity. At around $250,000 invested, people who move forward understand that the goal is not to maximize effort, but to maximize impact. They ask better questions. Where does my effort create the biggest long-term return? Where am I still trading time inefficiently? This mindset shift often leads to fewer activities, not more. Fewer meetings, fewer commitments, fewer distractions, and more depth. Depth compounds. Another thing that changes is how you respond to comparison. At this stage, comparison becomes optional. You're no longer trying to keep up. You're building something specific, personalized, aligned with your values. That internal clarity reduces emotional spending. You stop buying things to signal success. You invest in things that support your system. This is also where many people first experience the strange feeling of having money, but not wanting to spend it impulsively. Not because they're afraid, but because they see opportunity cost clearly. Every dollar spent is a dollar not compounding. And once you've felt compounding work, it's hard to ignore that trade-off. This is also the phase where people start thinking more seriously about risk concentration. Too much exposure to one job, one asset, one market, one idea. Diversification becomes practical, not theoretical. They don't over-diversify out of fear. They balance exposure out of wisdom. Another subtle change is how people handle boredom. Long-term investing can be boring. Very boring. And boredom pushes people into unnecessary action. Trading too often. Changing strategies. Chasing excitement. People who break through learn to sit with boredom. They understand that boredom is often a sign that the system is working. Excitement is usually expensive. This is also where the concept of enough starts showing up. Not as a finish line, but as a reference point. You start asking yourself what level of lifestyle truly matters to you, not what looks impressive online. That awareness protects you from lifestyle inflation traps that destroy compounding. At this stage, many people start caring deeply about alignment between money and health. Because they realize that wealth without health is a bad trade. They invest more in sleep, fitness, and stress reduction. Not as luxuries, but as performance assets. And performance affects income, decision-making, and patience. Another key shift is how you plan. Plans become more flexible, but more thoughtful. Instead of rigid timelines, you create ranges, scenarios. You prepare for multiple outcomes. This makes you resilient. Resilience is one of the most underrated wealth accelerators. This is also where people often begin mentoring others, even informally. Not because they have all the answers, but because teaching reinforces discipline. It reminds you why you started. It keeps you grounded. Platforms like Money Spectrum thrive here because this is where people want substance, not hype. Clarity, not shortcuts. Another important change is emotional regulation. When your portfolio fluctuates by tens of thousands, emotional discipline becomes non-negotiable. You learn to respond slowly. You pause before acting. You question impulses. That pause saves money over a lifetime. At this level, many people realize that wealth is not built by constantly being right. It's built by avoiding being catastrophically wrong. Risk management becomes invisible but powerful. You also start understanding that some opportunities are only visible when you're already stable. You need a base to see long-term plays clearly. This is why building the first $250,000 is so critical. It gives you a platform, not a finish line. If this part resonates, leave a comment with the word alignment. It signals to the algorithm and helps more people find long-form thinking like this. When people look back years later, they often realize that hitting $250,000 invested was not the moment they became wealthy. It was the moment they stopped being fragile. Everything after that was built on stability instead of struggle. This is where the true power of compounding finally starts to reveal itself. Not as a sudden explosion, but as quiet inevitability. You stop asking if, and start asking when. When your capital reaches this level, time becomes the dominant force. Markets don't need to be perfect anymore. You don't need home runs. You don't need viral wins. Average results, applied consistently, start producing extraordinary outcomes. This is the point where wealth begins to feel predictable, and predictability changes how you live. You stop making fear-based decisions. You stop reacting to every headline. You stop feeling like one mistake will ruin everything. That emotional stability alone dramatically improves outcomes. This is also where people realize how close they actually are. Before this stage, financial freedom feels distant and abstract. After this stage, it feels measurable. You can model it. You can see the trajectory. You can feel the momentum. That feeling changes how you wake up in the morning. You're no longer chasing money. You're managing a system. And systems scale better than effort ever will. At this level, people who succeed long-term stop asking how fast they can grow and start asking how sustainable their growth is. Sustainability becomes the filter for every decision. Can I maintain this strategy for 10, 20, 30 years? If the answer is no, it doesn't matter how exciting it looks. This long-term lens eliminates most bad decisions automatically. Another realization that hits hard here is how few big decisions actually matter. People stress over small optimizations while ignoring the fundamentals. Asset allocation, behavior during downturns, consistency over decades. Those are the levers that matter. This is also where people finally internalize that wealth is not about winning every year. It's about staying in the game, avoiding forced exits, avoiding emotional blowups, avoiding lifestyle traps that drain capital. Staying in the game long enough guarantees results if the system is sound. At this stage, money also starts creating optionality in subtle ways. You don't notice it immediately. But over time, you realize you can take career risks others can't. You can invest in learning, you can pivot. You can pause. That optionality is the real return on investment. It's also why people with similar portfolios but different lifestyles experience different levels of freedom. Freedom is not just net worth. It's flexibility relative to obligations. People who protect flexibility feel wealth earlier. This is also where gratitude quietly replaces urgency. Not complacency, but appreciation. Appreciation for the fact that you are no longer racing against survival. Appreciation for the discipline that got you here. And that appreciation fuels patience instead of killing ambition. Another powerful shift happens in how people think about legacy. Not necessarily inheritance, but impact. What does this money enable beyond consumption? Security for family. Time with loved ones. Contributions to things that matter. When money stops being the main character, it becomes a tool. This is the stage where wealth becomes invisible to outsiders, but obvious to the person living it. You don't need validation, you don't need to signal success. Your peace speaks for itself, and that peace compounds too. Many people underestimate how rare it is to reach this point. Most people never build meaningful invested capital. They earn, spend, repeat. If you've reached or are approaching this level, you are already in a small minority. But the real separation is what you do next. Some people coast. They let lifestyle creep absorb progress. They tell themselves they'll optimize later. Years pass, inflation eats quietly, momentum fades. Others stay intentional. They keep learning, they keep systems simple. They protect their downside. They let time do the heavy lifting. Those people wake up one day and realize the game has changed again. Because once compounding truly takes over, growth stops feeling earned and starts feeling inevitable.